So here we are for class 9. Last class I hinted at equity-linked annuities. But before we can do equity-linked annuities, we need to do some basic on options. And we are going to focus solely on call options. We will get into other types of combination of options just because when we talk about annuities later, you're going to see we'll bring up this concept of an option strategy related to that particular product. This option basics is what I covered in my principles of investment class. So if you had that class and remember all of this, flip ahead from the green section to the orange section, and you'll see the next section where we actually work a problem related to equity-linked annuities. But if you go into Yahoo Finance, to give a good basic overview of options, I went to MetLife. We're doing life insurance, so I picked a company that's in the life insurance industry. Its stock ticker is MET. On the particular day I did this, it was trading at $38.20. It had a slightly down day, but not terribly down day, 11 cents. So when you go on to Yahoo Finance and you type in MET, it'll bring up this summary page, and over here on the far right it says options, and when you click on that options, it will bring up several options. I changed the option to December 18, 2020. When you bring this up in Yahoo Finance, the first time it will bring up the next option that trades for the current month, but that's too short term. We want to go out further than that. But if you look on this page, they'll give you the contract name, which we don't need to worry about that. This is just an option on MetLife. It's a call option. We are not going to talk about put options in this section much. We'll allude to them, but we need, remember with the equity-linked annuity, we need something that's going to give us the upside of the market. And that's what call options do. And we'll talk about call options, and you'll see exactly how it does it. The call options give you a very exaggerated, leveraged way to get the upside of a stock or of a market. Now, this is MetLife. When we do equity-linked annuities, we'll be tied to the S&P 500 because we're trying to get the overall stock market. So just to give an example of how options work, I'm going to use MetLife. And you can see they have a trade date, when it was the last trade. They have the strike. So that strike price is real important. We'll talk about the strike price here in a little bit. They show the last price of the option, the bid and the ask. We're going to focus on the ask price because the ask price, you notice, first of all, the ask price is higher than the bid price. We are talking about buying call options. I won't do this on the exam. On the exam, I'll only give you one option price. But in reality, there's an option price if you're buying options, and there's an option price if you're selling them. And it's always easy to remember because you know you're going to come out behind. So if you're buying an option, which is what we'll be doing, is buying options, we'll pay the higher price. If we were to turn around and sell that option, we would pay the lower the bid price. So we buy the ask price and we would sell at the bid price. Now you'll notice the bid-ask spread for MetLife is extremely wide. So this is really not a good option to use. The numbers all work, so I'll keep using it, but there's a really wide spread between the bid and ask, meaning there's probably not much volume here. You can see there's only one contract out there, so very, very low volume, which is fine. This means you definitely would be careful trading this to make sure you don't get ripped off by your broker. But what we're going to do is go down to a strike price of $45. So let's real quickly talk about a call option. If you've never seen a call option before, there's some places you can go and look it up and get some training. You can just Google it, but let me give you the basics of it because it's really not that difficult. So a call option gives you the right to buy something at some given price within some given amount of time. So what can you buy with this call option? Well, you can buy MetLife stock. Now we're doing one option. In reality, options are sold in contracts of 100. So you can't just buy one option, you have to buy 100. For this class, we're going to ignore this and we're just going to look. You can buy 80, you can buy 50. In this case, we're going to pretend like we're just buying one call option, even though in reality, to do an actual contract, you would have to buy 100. So just focus on one contract. So this is a stock that's trading for $38. The call option gives you the right to buy MetLife for $45. Now you might say, well, what value does that have? I can buy it for $38 right now. Why would I enter a contract to be able to buy it for $45? Well, the advantage you have now is I did this in August. So sitting in August, you have from between August and December 18th, you have the right to buy this stock for $45. And you have to pay a premium to do it. You have to pay 82 cents. That's the ask price. Again, notice the bid ask is very, very wide. Again, I can't tell you why. There's a little bit more volume here. There's 6 contracts out there, so 6 times 100, but 6 contracts out there. But you have to pay 82 cents. The nice thing about the call option is if MetLife stock price falls and is well below $45 as of December 18th, you haven't lost anything except the 82 cents. However, if the stock price shoots up to say $47, $48, $49, then you get to buy them for $45 and sell them at the current price. That could be $50. So you would make $5 and you only invested 82 cents, which is a really huge return. Much higher return than if you just bought the stock for 38 and went up to 50. So think about this scenario. Let's say you buy MetLife today, and at December it's worth $30. Well, you would have lost $8.20. Let's do another scenario. You buy their stock at $38.20, and their stock price is $50. Well, then you've made $11.80 as of December 18th. So that's how the stock works. So your downside is, if it falls to 30 bucks, we can lose $8.20. If it goes up to 50 bucks, we can make $11.80. Let's think about the call option. At the call option, you spend 82 cents and the stock price falls to $30. All you lose is the 82 cents. You don't lose the $8.20 that you would if you bought the stock. If the stock goes up to $50, then you can buy the stock for $45 using your call option and sell it immediately for $50. So you've made $5 minus your 82 cents. So you make $4.18. Now that's less than the $11.80 you would have made buying the stock. But think about it. To get the $11.80, buying the stock at $38.20, it goes to $50. You had to spend $38.20 to get $11.80. Over here at the call option, you spent 82 cents and you get a gain of $5. That's a much higher percentage return. So what we're going to do is I'm going to go into Excel and I'm going to show you exactly how this call option works under different scenarios, give you the formula that you need, and you'll use this formula on the exam. And then once we see that, we'll have everything we need to turn around and do this for an equity-linked annuity, and you'll see exactly how the equity-linked annuity works. Okay, so here's MetLife. Their current stock price is $38.20. The call option, expiration December. Remember, we did a strike at 45. We could have done a strike at 50 or any other number that's available. They usually go in round lots of $5. And the call premium, remember, we used a higher amount, which is the ask, so 82 cents. And I've done many, many options in my price. I usually get something very, very close to the ask price when I'm buying and very close to the bid price when I'm selling. When I was at UTSA, we were doing much larger trades, sometimes billion-dollar notional trades. We'd probably get something in between the bid and the ask. I don't know if we'd actually do this transaction given that the bid and the ask are so wide. Usually the bid and ask are only a penny or two apart from each other. You saw with MetLife it was almost 30 cents. So it's a pretty dangerous little option we have here, but we'll go ahead and use it. So there's all the information we need. So there's a few things we want to talk about. The first thing is this option is out of the money. And how do we know that? Well, it's out of the money because if you bought this option today to be able to buy MetLife for $45, would you execute it today? Would you buy a stock that you can buy for $38.20? Would you execute an option and buy for $45? No, you definitely would not do that. Would not be worth it to you. You can just buy the stock for $38. Why spend $45? That's what out of the money means. If we'd done a strike price of $35, we would have been in the money. So a strike of $35 would have been in the money because we would have executed the strike, the option today to buy the stock for $35 if it was trading for $38. But our strike is $45. Another way we know it's out of the money is that its intrinsic value is 0. So what is the intrinsic value? So here's the one formula you need to have. The intrinsic value of an option. And we're specifically talking about a call option. The formula for a put option, those that took my investment class, you'll remember that formula. They're very, very similar between a call and a put. We switch the stock price and the strike price. So the stock price and the strike price, we switch them in the formula. But the formula is you take the max of the current price minus the strike, the max of that, and 0. So what that means is a call option, you do not have to execute it. If you are out of the money, you just don't execute it. You would let it expire worthless. But if you're in the money, you do execute it. So remember, this is very different. If you buy the stock and the stock price falls, you lose money. But with the call option, the most you can lose is your 82 cents. So let's look at it here. Our intrinsic value here is going to be at the time that we entered this option at $38. We would take the max of $38.20 minus our strike, $45, the max of that, and 0. Well, since $38.20 minus 45 is a negative number, the max of that and 0 equals 0. So that means our option is out of the money. It could be right at the money. If we had an option with a strike price of $38.20, which is practically impossible, it's very difficult to find stocks that are exactly at the money. But if you're at the money, its intrinsic value would be 0 as well, so that's the third case. But we're going to be dealing with options that are at the money. You'll see in the exam question. So at the money means that the current price and the strike price are exactly the same. But for this one, I'm doing it out of the money, mainly because I want to show you a picture. We're going to talk about put-call parity, and I want you to understand the equity-linked annuity in terms of put-call parity. So get this in your notes, because this is not in the notes. I'm teaching you this in Excel. I think it's the best way to do it. So we're going to use this formula right here for the intrinsic value. The other thing we need to know is the gain. The gain or the loss on the option, for any option, and that's going to equal the intrinsic value minus the option premium. That will be our gain or loss. All right, so let's practice here. Here's our gain or loss on the stock, our gain or loss on the call. So let's put these formulas down. See if you can replicate this in Excel. You might hit pause and get all this set up. You don't need to type in all this stuff over on the side, but get all of this set up in Excel. Get this set up. And what I did over here, I have possible stock prices for MetLife stock as of December 2020 when the option expires. I'm going to do a gain or a loss on the stock and a gain or a loss on the call option. And then for the stock price, I start at $25, and I just go up. If you look at the formula here, I go up, take the previous one, and add $2.50, and I just go up by $2.50 all the way up. And I went up to, I think, $70. So I'm going to look at what if MetLife was worth $25 in December? What if it's worth $45, $50? We're going to use this formula right here. The gain or the loss on the option is going to be this intrinsic value minus whatever we paid on the options. So if you need to hit pause so you can get all of that set up, then go ahead and do that. Okay, so the gain or the loss on the stock. So the gain or loss on the stock is going to be the ending stock price minus the beginning stock price. So pretty straightforward. So here we're going to assume the ending stock price will do equal that $25 equals $25 minus what we started with, $38.20. You need to hit your function 4 key. You want those dollar signs, $B, $2. And pretty obvious, if we bought the stock for $38.20 and it's now worth $25, we lost $13.20. Now you can just copy that down and you'll see the loss you have. And then once you hit $40, obviously if you go from $38.20 to $40, you would have made $1.80. And here's your gain all the way up to $70. All right. Now let's do the gain or the loss on the call. I'll put these formulas off on the side so you can just see them, just in case you're having trouble seeing them. I'll do it in the same order they came in. So there's the first column, the second column. So now let's do the third column. Now in the 25, you just type in 25 to get it started. So the gain or loss, the first thing we're going to do is the intrinsic value. So we do equal max, open parentheses. So it's the current stock price, $25, minus, in this case, not the $38.20, but the strike price. So we click on that, hit your F4 to lock it in. The max of that and 0. So what would that be? If the stock's trading for $25, we are going to let this option expire worthless. So if I hit enter here, I get an intrinsic value of 0. So what we want to do is edit that. And we want to do minus. Remember, the gain or loss on the option is the intrinsic value minus the option premium. You will need to do this on the equity-linked annuity problem. So minus the option premium of 82 cents. So if you spent 82 cents on this option, this call option, and its price is below the strike price, then you just lose 82 cents. All the way down until when? See if you can think in your mind, when will you break even on this stock? Well, at $45, you start making money. So what happens at $45.10? Well, at $45.10, you'll make $10 in intrinsic value, but you paid 82 cents for that. So you'll make 10 cents trading the option, but you lost 82 buying the option, so you would have lost 72 cents. So what's break even? I'm going to say break even is $45.82, but let's see if that actually works. So let me type in $45.82, and you notice the gain or loss is exactly 0. Why? Because you make 82 cents on the option, trading the option, but you have to cover your initial option premium of 82 cents. So at $45 exactly, you just lose your option premium. Then you start making some money, and then it starts jumping up. Now you notice the option never makes more money than buying the stock on the upside. Why? Well, because when you go from $38 to $45, there you make $6.80. But with the call option, you only start making money once you hit 45. So you'll notice the difference in these two. So the gain on the stock minus the gain on the option is going to be $45 minus 38.2. Also, you have the 82 cent option premium. So, I'm sorry. So the stock will do better by $7.62. What is that? That $7.62 is the difference between the $38.20 and $45, the strike price. Because you won't make any money on the option between there and there. If it doesn't get above the stock price, your option just expires worthless and you lost 82 cents. Once you hit $45, then you start making money. So you're off by $6.80, and you're also off at 82 cents. You add those two together, $6.80 plus 82 cents, and that shows you that your call option will always be that much cheaper than buying the stock itself. So that's just the nature of it. Until you get to the downside. Now on the downside, the stock price keeps falling and falling and falling, but the call, the most you can lose is 82 cents. So once you hit $45, the most you can lose is 82 cents and use a stop. All right, let me put this formula over here. We've already seen this formula. If you put everything in the exact same cells I did, then you'll see this exactly how I have it worded. So there's all of our formulas. Now in the exam, you'll be using this formula, this max, which is the current stock price minus the strike, comma 0, minus option premium. You'll have this. Well, I'll show you how you do it with the equity-linked annuity. So let's do a graph of this. This is a very, very interesting graph. So I'm going to graph, and you have to do this graph on the exams, so yours will look very different. Well, actually, you'll calculate it very differently, but it actually will look very similar to this. So if I insert just a line chart, what you'll notice is the stock price is just a diagonal line. If the stock price goes down, you lose money. I can even put in here, and this would be good to put into your exam answer as well. I can make the x-axis have labels, which is just the stock price. So you want to have labels related to stock price. So let me fix this up just a little bit. All right, so as the stock price falls, you lose money. As the stock price goes up, you make money. So here's the call option. This is a very, very popular strategy. You're going to see when you do the equity-linked annuity, it's going to look almost exactly like the call option. The one exception is we're going to set up the equity-linked annuity so that it never goes negative. So your worst case scenario is you make a little money, and then at some point you start getting the upside of the stock market. So you're protected from the downside, but you get the upside. So series 1 is the stock, series 2 is the call option. All right. See if you can create that yourself. This is a pattern. When we talk about put call parity, you'll recognize this pattern again and again, but this is very much the pattern of an equity-linked annuity. So the graph you're trying to get on the exam will look just like this, except you want it above the line. And since the exam, you can use Excel, probably good to go ahead and do an Excel chart and clean up the chart depending on how much time you have. All right, so there's the basics of how a call option works, and we'll be dealing with call options. So there's the basics. Very important to understand this in finance. Options are extremely important. In insurance, conceptually, they're even more important because that's what insurance is. Insurance are options. If you think about auto insurance, if the price of your car, it's a little different. It's a put option, so that's not a good example, but it's a put option. But insurance is really a put option on a car. It has a different, it goes up and comes down and goes flat with the put option. But if the value of your car drops dramatically, then it pays off. But if the value of your car goes up, you just get a flat line. You just pay your auto insurance premium. So insurance really are options, and there's a lot of option mathematics that you can use in insurance to understand these products better. So even if you're an actuary, not a finance major, you still need to understand options. And I have not taken any actuarial exams. I have seen the investment part. My guess is options are probably covered fairly well in the actuarial exams in some way. So there's our MetLife. You could experiment with others. If you want more on this, my investment class that I did last semester, at the end of the semester, I did a lot more of this options material. Let me know, and I can give you links to those classes. And what you want to watch those videos. I don't just do call options. I do call options, put options, protected puts, which is really what life insurance is, but protected puts is when you buy the stock and buy a put. I do straddles and strangles and collars and covered calls. The one we'll see later in this class is the strangle or the straddle. You'll see why life insurance, why the straddle or strangle is such an important concept to insurance. So hopefully that's a good basic understanding of options. There's plenty of resources you can go to understand them. I love them. I buy options all the time. At USAA, I bought a lot of options. In fact, I introduced USAA to options in a really big way. We're doing quite a few of them under my tenure. I don't think they're doing that anymore, but it saved us. In 2008, we actually had a positive return on our stock portfolio when the market was down 35%. It's just the power of options. So let's think about this equity-linked annuity problem that we're going to do. So MetLife, in our example, the stock of MetLife is what we call the underlying. That's the stock or index that the option value is based off. For our problem, we're going to use the S&P 500. The S&P 500 is a stock index. It's the most popular one and most closely followed stock index in the world. It follows 500 of the largest stocks in the U.S. It's not all the largest stocks. I don't think Berkshire Hathaway is in the S&P 500 yet. And there are some larger firms that are larger than the smallest firms in the S&P 500 that are not in the S&P 500. And because of that, no, S&P actually has a committee. And the reason there are some firms missing, like Berkshire Hathaway and some others, is the S&P wants to make sure they have a good mix of industries. So there's a little bit. It's supposed to be a passive index, which means they're not trying to beat the market and they're not trying to make money, but there is a little bit of active in how they pick stocks for different industries to make sure they have the right industries. But after that, it is market weight. So a stock like Apple, which is approaching to be a $2 trillion company, will have a 10 times bigger weight than a firm that has a $200 billion market cap and a 100 times bigger weight than a firm that has 20 billion market cap. So, so that's the underlying. So we'll be using the S&P. We'll be using a call option. Call option is a derivative. A derivative is a special type of security that derives its value from something else. In this case, from the underlying S&P 500 or MetLife stock. An option gives you the right, not the obligation, but the right. So you have the choice. That's why it's called an option. To buy an underlying security at a given price. We call that the strike price, before some given expiration. All right, so let's talk through the scenario. We'll come back to put call parity later, but let's run through our scenario. Let's first understand at the money, in the money, out of the money. We talked about that a little bit already. So the S&P 500 is at 3,200. I don't know where it is today. We just hit a new record just a few days ago, so probably higher than that. An at the money option will have a strike price of 3,200. So you have to know that, because what I give you on the exam is I do buy an at the money option. So you have to know that that means the strike is 3,200. That's the only one. I don't have to tell you what the strike is. If I tell you the option was out of the money, that doesn't tell you what the strike price is. 3,500 is out of the money, but so is 3,600 and 4,000. So if I say it's out of the money, you do not know the strike. If I tell you that it's in the money, 2,900 is in the money, but so is 2,500. But if I tell you it's at the money, you know what the strike price is. The strike price is wherever the S&P is today. That's what at the money means. So remember, out of the money, that's an option where the strike price is higher, a call option where the strike price is higher than the current price. It has an intrinsic value of 0. Remember, max of the stock price minus the strike price. So that gives us the intrinsic value. So if you're taking the current price, 3,200 minus 3,500, that is a negative number, and we're doing the max of that in 0. And so if the strike price is greater than the current price, you're out of the money, the intrinsic value is 0. If you're in the money where the strike price is less, this one's in the money by $300, then that's in the money you have a positive intrinsic value. But if the intrinsic value, remember, for out of the money, the intrinsic value is 0. The intrinsic value is also 0 at the money, because there we're just taking 3,200 minus 3,200, and the max of that and 0 is 0, because that's just 0. So, and at the money call option is very important for us to understand. The formula we're using right here is the value of a call option. This is the intrinsic value. It's the max of the stock price. I use S for stock price, and I use X for the strike price. Now you'll see it two ways. It depends on whether you are a bowler or a baseball player. I've always learned the symbols. If you've ever heard of the Black-Scholes option pricing model, they use these symbols. They use S for the stock price. The ones I've seen actually use K for the strike price. But the word strike, you can think in bowling, you get a strike, they give you an X. In baseball, if you get a strike, which is a bad thing, they give you a K. K for strike. So you'll sometimes see X, sometimes you use K. I always learned it as an X, so I'm giving you the X. So with a call option, the value at expiration, and this is the same thing as the intrinsic value, is the max of the stock price minus the strike price times the number of options that you have. That's the one other thing we have to add. Remember, in the MetLife, I only had one option. In this particular math example, you will have multiple options. So the max of that and 0. So right now, if it's 3,200 and 3,200 or 3,200 and 3,500, then your intrinsic value is 0, because the stock price is either equal to or less than the strike price. For a put option, it's the exact same thing. We're not going to do with put options, but it's important to understand put options, because that's really what insurance is. Here, it's the strike price minus the stock price, because here gives you the right to sell the security. Here, this call option gives you the right to buy the security. Here you have the right to sell the security. So if the strike price, you start with the strike price, because that's what you get to sell it at, minus the stock price, that will be your gain, unless the stock price is actually greater than the strike price. Then obviously the put didn't help you any. The put helps you when the stock price falls. The call option helps you when the stock price rises. We're going to do a CAGR, which is the compound annual growth rate. Compound annual growth rate. And you should have had this in a previous class, but if not, you'll use it a lot in your career. So we just want to know, what is the annual growth? What is the annual return? We take the ending portfolio value divided by our beginning portfolio value, raises the 1 divided by the number of periods of time minus 1. Those are my property and casualty class. Remember, we use that and when we're pricing the insurance. So you'll use it. We'll use this formula quite a bit when we price life insurance as well. So that's the compound annual growth rate. We'll come back to put call parity, but essentially what put call parity says is, if you buy a stock and a put option, you will get the exact same return as if you bought a call and you bought a bond whose maturity value is exactly the strike price. Now these are all at the money. So if you have a stock that's $38.20 on MetLife, and you buy a put option with a strike of $38.20, and that should be exactly equal to buying a call with a strike price of $38.20 and owning a bond that, we did the same December call option I showed you for MetLife, a bond whose maturity value in December 2020 would be exactly $38.20. So that's put call parity. We'll talk about what that means here in a little bit. One thing to really understand is this right here. Let's go on and do it now, because boy, this really I should do an essay question on the exam to have you explain how put call parity explains equity linked annuities. So remember the shape of the call option. It looked like a hockey stick. When the stock price fell, all you could lose was the 80 something cents, 82 cents. As the stock price rose above $45, you started making money on the call option. So it's a hockey stick where you had a downside was protected and you had upside. Well, The call option is buying a call option is the same thing as buying the stock and buying a put and selling a bond whose maturity value equals the strike price. We're going to discover that this is essentially what an equity-linked annuity is. So we'll see when we move all these around the same shape. We're also going to see if we move the call, well, we're here, the stock plus the put. That's the same thing as a call plus the bond. This is real similar to equity annuity as well. Doesn't quite look like it. And you'll see when it's because of the downside. But anyway, we're getting into the ballpark of what an equity annuity is. It essentially looks like a protected put. It also looks a lot like the call option, and you'll see there's a lot of similarities between these different strategies. That's one reason why I keep emphasizing why I would never buy one of these. Is there's so many ways to replicate this on your own, and it's what put call parity is talking about. How can you replicate one security by combining other securities? And what that's telling you is the call option is 82 cents. But you can enter this transaction at 80 cents, and what you should do is buy this for 80 cents, sell that for 82 cents, and you have what we call an arbitrage profit. You have a 2-cent profit, where there's no way, because you know at expiration, these two sides must equal each other. So if this is 80 cents and that's 82 cents, buy this, sell the 82, buy the 80, you got 2 cents. If you did that on 1,000,000 shares, you know, you got $20,000 locked in with no chance of losing it. Would be a great transaction. All right, so usually these two sides are very, very close in price, especially once you take the bid-ask into consideration. Sometimes you'll find a little bit of gain when you combine all these together and look them up, but when you take the bid-ask spread in, you end up losing any gains you could get. But anyway, you need all of this stuff except for the put-call parity. Put-call parity, I might some way work it into an exam. Just to make sure you understand. I haven't done that before, but it would be really cool to do that. I do work in the straddle when we talk about annuities later. But anyway, good stuff to know, really powerful stuff to know, especially in interview questions, because it shows good comprehension of what we're doing. So what we're going to do here is we're going to work this problem from the prior exam. Your problem on this in our class will be very similar. We'll do this in the first exam of the class. Will look very, very similar. I'll just change the numbers slightly. So here's the numbers. It's a single premium deferred equity-linked annuity. That's a pretty unusual annuity. Very few of them are single premium. However, this just helps simplify the math. We're seeing how it really works in practice. There's a little bit more you got to work with in practice because you're getting more than one premium throughout time. But it doesn't really complicate it that much. Just the math gets a little messy, but the actual transactions are not that bad. So we have a $300,000 annuity. So someone walks in with $300,000 and hands it to us. It's a 10-year annuity, so it matures in 10 years. And while not all equity-linked annuities don't necessarily mature, but just to keep the math simple here, maybe you're 60 years old, and you want to build this annuity until you turn 70, you have to annuitize it, so it's got 10 years left. And you've got a guaranteed rate of 1.5%. So the worst you can do is make 1.5% over the next 10 years. But what we're hoping is to get some of the upside of the stock market. Let's say the S&P 500 is currently trading at 3,000. And an at-the-money S&P 500 index call option maturing in 10 years. Now, we do not really have one of these that matures in 10 years. That would be an extreme, what we call a leap. A leap is a long, long-dated option. However, the insurance company can manage that with how they roll these things forward. So I'm just keeping everything simple. And then the other thing we have is a 10-year zero-coupon corporate bond. Now, life insurance companies don't buy zero-coupon bonds. But again, we're going to do that just to keep the math simple. So I'm doing some things to keep the math simple, but in practice, once you get this set up and you're doing your trades, it's really not all that complicated. So I'm just trying to cut down on you having to do multiple calculations. So that's what we have. So the three questions you have, and then the fourth question is the graph. We'll talk about the graph. The three questions is how much should they purchase of this zero coupon bond so that they can lock in the 1.5% return? And then how much of the call options should they purchase with whatever's remaining? How many call options can they buy with whatever's left over? Obviously, they won't need the entire $300,000. They get the 1.5% guarantee. Why? Because they're expected to make 3.5% on this corporate bond. All right, so there's the key. That's why I say this is hard to do today because interest rates are so low, but there's the key. If you find a mutual fund that's yielding, say, 3%, and you want to guarantee yourself a 1.5% return, you just make sure you put, if you got $300,000 to invest, you put enough of your $300,000 into that mutual fund such that your expected return is 1.5% over the next 10 years. And then whatever is left over, whatever you did not use that $300,000, you can then put that into a call option so that you get some of the upside of the S&P 500. So the first question is, how much of that $300,000 should you put into the bond? The next question, how many call options should you purchase? The next question is to fill in this table. We'll do that. And then the last question is to have you draw a graph. And the reason I want you to draw the graph is it gets back to what we were talking about previously. On this page, what we're creating with the equity-linked annuity looks a lot like the call option, but also looks a lot like the protected put. The protected put is a stock plus a put option equals a call plus a bond. Essentially what we're doing is we're creating a protected put, but we're going to do it using a call and a bond. We could have created the equity-linked annuity doing a stock plus a put, but what we want to do is, remember when I showed you the graph for the call option, it was below the line. We want to manufacture this, buy enough of this bond so that we actually get a minimum loss. We don't lose more money than what we're guaranteed here, 1.5%. All right, so then we'll draw a graph, and the reason I want you to draw the graph is I want you to see how the graph looks a lot like the call option we did. And also, if you looked at my videos from the investment class I did, you'll notice when I do a protected put that graph looks a lot like the call option as well. So there's a huge relationship between all of these. So let's work through the math. All right, so here is the problem in Word. So I'm going to work this in Word. And let's start with this first question. How much, and there's another video of this, so you'll have more than one example of this. So how much should the insurance company place in the zero coupon bonds today? Now, again, those of you that took my property and casualty class, I don't know how much you remember of the catastrophe bonds, but with the catastrophe bonds, we did something very, very similar to this. I'll work on another one of these problems again in our next session. So this is a quick introduction to it. So we need, at the end of this contract, this person needs to have $300,000 at a minimum, $300,000 times 1 plus 0.015. They need to have 1.5% for 10 years. So we need to, at the end of this contract, we need to make sure that we have $348,162. And you can ignore rounding for this. You know, I don't care if you round up or round down, but $348,000. How are we going to get that $348,000? Well, we're going to get it by investing at 3.5%. So how much of this $300,000 do we need to invest at 3.5% to make sure at the end of 10 years we have at least $348,000? Well, the key there, so this is the ending portfolio guaranteed value. So how much to invest today? Well, that's going to be $348,162 divided by 1 divided by here, not times, divided by 1 plus 0.035 raised to the 10th. So we get this is the future value at 1.5%. And here we're going to get 246,819, and that is the present value at 3.5%. So hopefully you're an expert in present values and future values. Actuaries in finance, we use those a lot. So there's our answer. How much of this bond should we buy? We need to buy 246,819. If we do that, if we invest $246,819 at 3.5%, we will have a portfolio worth $348,162 at the end, which is just enough that this person makes 1.5%. So we got money left over, right? They gave us $300,000. We're only investing $246,819, so we have money left over. What do you do with that money left over? You can do whatever you want to with it. You could put it in one stock. You could put it in one country. You buy an exchange-traded fund of Bangladesh if you wanted to. You could put it in call options. You could go to Vegas and gamble it. Whatever you did, you know in 10 years, your worst case scenario is you make 1.5%. I think it's a great way to think about risk and investing. So how much money do we have to play with? So they came in with $300,000, but we only invested $246,819. So we will have $53,181 to invest. In our case, we're going to invest them in S&P 500 call options. Now that's not what the question's asking, but that's an important component of the question. This is how much we have to invest. So this is in dollars. The question is not asking how much are you investing. The question is how many options do you need. So the number of options is going to equal the 53,181 divided by the option premium. Well, the option premium is $850. Here's another place where rounding is fine. So you have 53,181. That's money that you could put anywhere you wanted to. And we decided to put it in S&P 500 call options. Why? Because that's where our contract says. It says that they get the upside of the S&P 500. So how many contracts is that? I just rounded to 63. So there's your answer to the second question. So we need 63 contracts. Again, I'm ignoring the fact that options trade in 100 units of 100. And if you think about it, if this insurance company is doing millions and millions and millions of dollars of this, it doesn't matter that one particular customer only needs 63, because between all of them, they may need thousands of options. So they'll be able to get the math very precisely close without any trouble at all. So we actually can do 63 options because the insurance company can buy contracts for all of their customers, and they can just divvy them up between their different customers. So if you're used to hearing that options trade in 100 units of 100 in contracts, then that's not important for what we're doing here. We're just doing individual options. All right, so let that sink in, practice it a little bit, and now what we're going to do is the table. So on the table, what I'll do is below the table, I'll give you the formulas below down here. So the ending portfolio value for the bond portfolio. Well, we don't really need to do any calculation. We already know that. We already know that this bond will mature. So I don't need to do math there. It's going to mature at 348,162. Doesn't matter what the S&P 500 does. So let me make sure I forgot to talk about the axis over here. So I'll give you three scenarios. The S&P could drop a bunch down to 1050. the S&P could stay right where it started at 3,000, or the S&P could rise to 7780. Now these look like really huge gains and losses, but we're over 10 years. So these gains and losses are probably only about 10%. If you lose 10% every year for 10 years, which would be really horrible for the U.S. stock market, the stock market would drop by almost 2/3. And then it would more than double if it went up about that much every year. So there's any portfolio of the bond, doesn't matter what the stock market's doing. The only risk here is that this thing goes insolvent. Now the ending value of the call option. So here's where we're going to do max of current price minus the strike and 0. And here we don't have to worry about the 53,181. We're just going to do the gain and loss of the option itself. So this is not actually the gain or loss on the option portfolio. This is actually how much is the option portfolio worth at the end, because we've already taken it out of 3,000. You'll understand that when we do the returns over here. So if the market falls to 1050, we take 1050 minus 350. I mean 3,000. Sorry, 1050 minus 3,000. There's where the strike price is. That's a negative number, so the value there is 0. 3,000 minus 3,000, the value there is 0. So the one other thing you have to do is you have to take the intrinsic value times the number of options. And so here we're going to take the max of 7780 and we'll subtract from that 3,000, comma 0. That's obviously going to be 4780. Multiply that by our 63 contracts. And when we do all of that, we will get a value of 301,140. So check your math on that. Make sure you've got it down by 301,140. And so the value of the equity-linked annuity is you just add across. So here, 348,162, 348,162, and here we just add across. We add across, we get 649,302. All right, so there's the value of our equity-linked annuity. Now we want to calculate the returns. To get the returns, remember we're going to do ending value divided by beginning value raised to the 1 over n minus 1. On the first two, we don't really need to do this because we already know, I mean, you can look at it, but we already know it's going to be 1.5%. If the equities fall, all we have left is the bond portfolio, and so there we are going to get is 1.5%. So let me do this formula at the very, very end. So here what we're going to do, the ending value here is 649,302. Remember, they came to us with $300,000. We take all of that and we raise it to the 1 divided by n, remember 10 years, minus 1. And we do all of that, you should get a return of 8.03%. All right. Let that sink in, 8.03%. And that's an annual number, so that's a really good return, right? 8% a year. Now let's look at the S&P 500. It's the same formula. Exact same formula. Let's see if I can stretch this out a little bit. So same formula. So here we're going to take the ending value is 1050 divided by 3,000, raised 1 divided by 10 minus 1. When you get that, you get minus 10%. And so obviously you did a lot better with the equity-linked annuity, 1.5% versus minus 10%, so that's really, really good. Now what about here? Well, here is pretty straightforward. You got $3,000, I mean 3,000 divided by 3,000 raised to the 1 divided by 10 minus raised, not times, excuse me. That's equal to 1 because you have 1 raised to the 1/10 minus 1, and that's going to equal a 0% return. Again, the equity-linked annuity has done better. So when the market's flat or down, you'll do better. What about when the market's up? So here we have 7780 divided by 3,000 raised to the 1 divided by 10 minus 1, and that will equal positive 10%. And so there you have your everything you need. Down here are the formulas. And there's your returns all the way through. So it's looking like an okay product. But again, remember the article we read, because it will not be this good for you if you buy the equity-linked annuity. There's fees that they charge. This is only a price index. This S&P will actually have price plus the stock market dividend. So you have an extra 2% return on top of this. That's not included here. So probably even when the market was flat, you probably still did better. You probably did better with the stocks because you would have gotten an extra 2% dividend yield, which is not in here. This is only price related. And then you have all those different averaging methods and everything else going on. So this is, if you build it yourself, this is what you get. If you use the life insurance company to do it, you'll get much less than this simply because there's no way they got to charge fees and make a profit. All right, so there's letter C. It says show all your work, and that is important on exams, my kind of exams, mainly because I don't count off for math errors if I can see the math error. But if you don't write down the math error, if everything is plugged into a cell, I can't do it. Now, if you submit this by Excel, your math will be shown in the Excel, but you're still better off, so you can just prove to me you understand these formulas, actually writing them out in words on exams. You might do that at the very end to make sure you have time, because there is some time constraint on these. But anyway, that's how equity-linked annuity looks versus the overall stock market. Now what we want to do is graph this. And so let's try graphing this. Okay, so I set up this problem in Excel. And down here is our table. This looks exactly like our table. So what we want to do is to do a graph. And essentially what we want to graph is this output at the end. Now if we do this in Excel, I might give you more scenarios because it will look a lot better with more scenarios. So be ready for that. Be able to do more than one. So this could become a little bit of an Excel. If I do that, I'll give you a practice problem to work with it. So what we want to do is insert a graph, a line graph. So there's our chart. What we want to do is add an x-axis. So first thing, I don't like the axis labels to be near the axis. I like them to be low. I don't like negative numbers. I don't like numbers going through my graph. And the other thing we're going to do is we need to add the points. So we can select data. We want to edit the x-axis and put in the reference to the S&P 500. And so when we do that, you'll see that we have this chart here. And the orange line, and you can put labels in there. It would be really good to put labels in there. So the orange line is the S&P 500 stock index. Oops. Stock index. And the second one is the equity linked annuity. Boy. And don't hit your arrow keys when you're in these graphs because it thinks you want to go to another cell. So there we have it. Now if you look at this, again, look at that blue line. Doesn't that look very, very, very similar to what we did when we did the call option. So here's the call option over here. Here's our equity-linked annuity. You notice it looks almost identical. It's the same shape. The difference is equity-linked annuity is above 0, whereas the call option is slightly below 0. And then you have the S&P 500. And you can see at some point the S&P 500 will outperform, and you won't make as much. It doesn't look like you're giving up much, but when you compound this over 10 years, that 2% difference is huge. The difference between 8% and 10% is quite large. In fact, you want to look at this. I can even show you. So what is the difference? So if I take $300,000 times 1 plus what the stock market did, raised to the 10th, my portfolio would have been worth, make sure I have enough zeros, my portfolio would have been worth, and you could kind of tell that from the ending value of the S&P, would have been worth $778,000. Instead, it's only worth $649,000. So I'm giving up over $100,000 by getting this protection on the downside. But it's kind of nice to have $348,000 instead of $105,000 on the downside. Now, it's extremely unlikely the S&P is going to fall 10% every year for 10 years, or on average for 10 years. That would definitely be incredible. But the Japanese stock market did that, and that's a very large market. So it is possible. It's conceivable. So this is the graph you want to have. And this is what I'm talking about, that this really looks like a protected put. Protected put is a call option plus a bond. A protected put is a stock plus a put option, but it's the same thing as a call option plus a bond. This is essentially what we have here. We have a bond, we have a call option. We have those two combined in our ending portfolio. That's the kind of return we can have, and it looks a lot less risky and a lot less volatile than the stock market. So we'll talk more next session. I want to talk more about this put call parity. And let you see how insurance can really be understood a whole lot better if you bring in option pricing theory. But we've worked one example now. We'll work one more example in the next one, and then we'll get a little bit more into this concept of put call parity. I find it real exciting. I find it even more exciting that we can do these things ourselves. So rather than have an insurance company with all their fees and all their expenses doing this for you, you can do it yourself. And I love this particular scenario. I do recommend this type of strategy for people, especially in their 60s and 70s. They need some upside, but they can't take the 30–40% drop. I think it's a great strategy. My only question is a life insurance company the best way to get this particular strategy, or would you be better off building something yourself? So we'll leave it there. Hopefully you're getting excited about this. There's something very similar. We're going to talk about this as well when we talk about longevity. So I'm hoping when you get to the pricing part of this class, I can show you some strategies that will get you very excited that this industry could create the perfect product that could really help a lot of people. It's just no one in the industry wants to sell it. So I'm hoping one of you will start a company and start selling one of these products. So, all right, we'll stop it there.